What is up, guys? My name is Lucas. Welcome to my YouTube channel. Today I wanted to discuss a topic that I myself have been looking at very closely for the past few months. And so we're going to pull up the SPY options chain. SPY is the ETF of the S&P 500 index, the 500 most biggest stocks trading on the New York Stock Exchange. So we're just going to go a month out to the October 11th strike price. And as you guys can see, this is the call side, this is the put side. Obviously, taking a look at the prices for each, you could see a very, very big difference. So the puts are trading at 60 cents for 25 strike prices out of the money. The calls, however, if you go 25 strike prices out of the money, are trading only for 11 cents. So why are the puts 6 times more expensive than the calls, right? Simple supply and demand concept. When the demand for things tends to go up, the prices for them tends to go up as well. And when there's no demand for something, prices stay low or go low. So therefore, there's more demands for the puts than the calls right now. And that is when the skew comes into the picture, right? So we're going to go here on the daily chart, and this looks very ugly. So I'm going to go ahead and pull up the linear chart. This is pretty much the past year since September of 2020. So you can see if we go on the weekly chart, we've been in an uptrend since early 2019. And so what is the skew? So skew shows the implied volatility of SPY options, but Lucas, doesn't VIX do that? So the difference between VIX and skew is that skew measures the implied volatility for the tail end out of the money options, right? So skew measures the outliers, while VIX is measuring the at the money implied volatility options, and both go a month out, by the way. That's why on the options chain right here, this is on skew. I'm going to go back to SPY. We went a month out to October 11th, right? So back to skew. So as the skew goes up, it shows that there is more weight on the out of the money puts or the out of the money calls. In this case, the out of the money puts, right? So the puts have been, getting way more expensive in the past few months and a couple of years. So as skew moves up 5 points, it's at 151 right now. Let's say it does move up to 156 in a few days, right? As it moves up 5 points, the risk for the out of the money calls or puts increased by 1.35% for the second standard deviation out of the money calls, right? So we're not going to go too in depth for the standard deviation, but again, back to SPY. This is a month out, right? This is the standard deviation, right? This is the first standard deviation, plus or minus. Let's just call it 20 for now, right? 2 standard deviations is 40. So what does that mean? Let's say, screw this, we're going to go back to skew. Let's say SPY is trading at 100, right? This is the mean. If we go to 90, let's say the standard deviation, the first standard deviation is 5 points for a month out, right? That's 95 and 105, right? So let's go 2 standard deviations now. That's from 100, that's 90 and 110, right? So as skew goes up 5 points, the risk for either one of these sides increases by 1.35%, right? If we go from 100, 3 standard deviations out, 85 and 115, which we're not going to go too in depth regarding the standard deviations right now. That's another topic for itself. But then in that case, the risk of those options will increase by 0.3%, right? So let's go to something like AMC, right? AMC, as many of you guys know, we're going to go a month out. As many of you guys know, it has been a hub for many of the retail investors, which do have, gambling mindsets, unfortunately, and they tend to think that the way to become successful in the stock market is just to gamble your money away. So we could see right off the bat, right, it's the same exact thing, but flipped around. The calls are more expensive. The put's only 30 cents. The call is $2, right? So why is the call 6 times more expensive than the put? And so let's talk about why this is kind of an occurrence in SPY where the put is more expensive than the call. So let's say Jared bought SPY at 4.15, random number, right? And then let's say he wants to hedge his position against all the 100 shares of SPY that he bought, let's say, right? If he bought those shares at 4.15, let's say he bought out of the money puts at 3.90 or whatever number you want to call it. And as his position goes up on SPY, the value of those puts expire as time decay kicks in, and it gets further and further from the strike price of the puts. But to hedge himself, he bought those puts just in case if SPY does sell off and goes past 390, the value of his puts will increase, therefore putting him in a less riskier position, right? Whereas if he were not to buy those puts, he would be in jeopardy of losing a way bigger amount of his investment, right? So that's when so why is this happening right now? So right now, not only on the technical side of things, I actually drew this line from a few weeks ago, or was last week. Not only from the technical side of things, we're up 500 and something percent from the financial crisis of 2008, but on the sentiment and fundamental side of things, the government has been, pumping a lot of stimulus and unemployment into the economy. And as that gets pumped into the economy, the stock market gets artificially pumped up. And after all, 40% of all US dollars have been printed in 2020, which is absolutely insane, right? So right now, we're not only overextended on the monthly charts, but we're very artificially inflated. And that is why majority of these hedge fund institutions and banks, right, are hedging heavily against their positions, right? And these guys are not going to, pay $3 for the call. Why? Because SPY is super overextended. We're artificially pumped up. We're in a bigger risk of a crash than we were, let's say, right here, right? Because we're super overextended. And that just shows that, the hedge fund managers are, and the institutions and the banks are very concerned. So therefore, when the skew goes up, you could say, in a sense, that most of the time the concern for the S&P 500 or NYSE, the whole pretty much stock market is high. There are a lot of concerns, right? So why is AMC the exact opposite? Why is GameStop, I'll show you guys in a second, the exact opposite, right? Because why is somebody willing to pay $2 for the call but only 34 cents for the put? Because most retail investors don't hedge, right? All they want to do, especially AMC traders, is win overnight and hit a jackpot. Whereas in SPY, which has way more institutions trading it, most of those traders and investors are going to be hedging themselves, especially because SPY is very overextended. But nobody is going to be like, okay, I'm going to hedge myself in AMC just in case I have 100 shares in AMC and AMC does end up falling to $25. I'm protected, right? Majority of the people in AMC want to hit an overnight jackpot. Same exact concept with GME, GameStop, right? 41 cents, $3.65. So guys, that is going to be it for today. If you guys do have any suggestions to go over in the next few days or few weeks or whenever, please let me know in the comment section. If you guys have any feedback, please let me know so I can make these videos better for you guys. And hope you guys enjoyed the video.